Today, we will be starting with accounting principles. Now, what is this accounting principles all about? Accounting principles are like grammars of English. In English, why do we have grammar? To make the communication much more clearer. Similarly, accountancy being also a communication tool, I want to communicate effectively with the users. To make the communication more effective, we have this accounting principles. So the basic idea of accounting principle is to make the communication clearer with the users. Uh, Look at this theory part. It provides a framework for recording, reporting, and interpreting financial information. Accounting principles provides rules which are followed in giving accounting treatment to various items of assets, liabilities, expenditure, income. Now, what do we mean here is look at the scenario. Suppose, for example, let's say we have purchased a machinery for rupees 65,000. Usually, what is the accounting entry we will pass for purchase of machinery? Machinery being an asset, asset increases, I give a debit, and cash goes down, I give a credit. So, entry will be machinery account debit to cash account. So, machine will be classified as an asset in the balance sheet. Now, we have a principle called as materiality principle. Now, what this principle says is, yes, machine is an asset, that's fine, but not for everyone. What the principle says is, suppose let's say a company is has been started with a capital of let's say some 2 lakh rupees. In a 2 lakh worth of company, purchasing a machine for 65,000 will be material amount or significant amount. In those type of cases, classifying the machinery as an asset is fine, acceptable. But let's think of companies like Reliance, Tatas, etc. In these type of big group companies, just for information purpose, Reliance, as of this December 25, what is the value of Reliance company? The value of company is almost 20 lakh crore. For a 20 lakh crore worth of business, an asset of 65,000, a machinery of rupees 65,000, they won't be calling it as an asset and all. So what they will do, they will book this entire item, machinery, as an expenditure in the P&L. So the classification will be entry will remain same. There is no change in the entry. What it says, the material principle says is for classification of an item as an asset, the amount has to be significant enough for the size of the company. So for Reliance Industries, this 65,000 may not be material amount for them. So what they will do, they will classify this machine as an expenditure in P&L. But for a company say of 2 lakhs or 3 lakh worth of rupees, for that company, the 65,000 will be significant. So the same machinery for some company it's an asset, for some company it's an expenditure. So this is what, and it's just an example of one of the accounting principles. This is one we have will be seeing few more accounting principles in this session. So let's start one by one. Now let's start with going concern. What is this going concern principle is all about? Going concern principle says that if a company is planning to close down the business or scale down the level of operation, so if you're going to close it off or if you're going to scale down your level of operation, then we say that going concern principle is violated. Now what it means is, I'll just give you some example for this. While doing the auditing as a chartered accountant, if you're going to certify any financials, it's our responsibility to speak about the going concern. Now look at this article here. Auditors express doubt on SpiceJet ability to remain a going concern. Now, what they are saying here, the auditors are casting a doubt on the company's ability to continue for a foreseeable future. Because of its mounting losses and lot of operational issues, the auditors are feeling that the company might close down in near future. So that's what this says about. Now, if this is a scenario, so if going concern principle is violated, what I should do in accounting? Here comes a question, right? Now, this principle says that if a company is planning to close down the business or scale down the operation near future, assets will be recorded at NRV, net realizable value, and not at cost. Generally, assets will be recorded at historical cost, but we cannot continue to record the assets at historical cost. If a company is planning to close down the business or scale down the operation, to communicate this point, what the firms will do is they will take down all the assets to realizable value and not at cost. We'll be showing the assets at realizable value. That's what this principle says all about. So if a company has going concern, that means if a company is likely to continue for a foreseeable period without scaling down the operation, you can continue to show the assets at historical cost. Whereas if the going concern is violated, we have to disclose the assets at their realizable value. I hope this point is clear. Now look at this theory part. There is no intention to, for going concern, what is going concern? There is no intention to close down the business or scale down the level of operation. It is because of this principle we have a distinction between trading and P&L and the balance sheet. So I'll just give you a scenario here. See, let's say payment of salary to a staff. What is the nature? Here also the cash goes out. The salary is classified as an expenditure. Purchasing a machinery. Here also the cash goes out. But the purchase of machinery is classified as an asset. Why? Because the company has got some future benefit. So the machine has got some future benefit. So if the company is likely to continue for a foreseeable period, the company will derive benefit out of the machinery. So to derive benefits out of machinery, first the company has to go on for a foreseeable period. If you're going to close down the business, you don't have any future concept. If there is no future concept, there is no concept of having in balance sheet, because that's what we have discussed, right? In the first session, what is balance sheet? In balance sheet, we'll be capturing all the future concept oriented ledgers. Example, all these assets, liabilities, or what are assets, future benefits will be called as an asset, and future obligation to pay is a liability. So for classification of some assets and liabilities, first we should have a future. If there is no future for the company, then there is no concept of having this balance sheet. So everything will go into trading and P&L. So that's what we are conveying here. If you look at this topic, what we are saying here, it is because of this principle. It's just because of going concern, we are distinguishing between trading P&L and balance sheet. If there is no going concern, the balance sheet will get wound up. There is no concept of balance sheet. We'll have only trading and P&L account. So I hope it should be clear. Next one, we'll move to consistency principle. What is this consistency principle is all about? It's very simple. Consistent. What is the meaning consistent? Whatever accounting policy you are following. Just for example, for depreciation, we have two methods of depreciation. There are more methods actually, but commonly used are two methods of depreciation. One is straight line method, the other one is written down value method. So now these two methods, between these two methods, the answer will not be same. The answer will be different. So whatever method you choose to follow, you have to follow that method consistently year after year. That's just all about consistency principle. It is a simple one. Once an accounting principle is chosen, it has to be applied consistently year after year. Example, method of depreciation, SLM or WDV. SLM is straight line method, WDV, print on value method. So what is this principle, what is this method all about? How it works, we'll see it subsequently in depreciation chapter. So consistency is very simple. Whatever accounting policy the company chooses to follow, the company has to apply it consistently year after year. Simple, done. Next one, we'll move to accrual concept. What is accrual? Accrual concept is nothing but when I purchase a machinery, or let's keep it as goods. Now, purchase of goods, I'll just give you some scenario here. Purchase goods from Z rupees 5,000. What is the entry we pass here? The entry is purchase account debit to Z account. Amount is 5,000, 5,000. Purchase will be classified as an expenditure. And what is it? I have to pay this guy in future. So it's an obligation to pay, it's a liability. So in this case, what happens? Even though we have not paid the amount, still we are recording the transaction. That's what accrual concept says about. What the principle says is, once a transaction accrues or occurs, we have to record the transaction immediately, and we can't wait till the cash is received or cash is paid. So receipt or payment of cash is irrelevant from accounting perspective. Once a transaction has occurred, we have purchased the goods, right? So the purchases has to be recorded immediately. Despite that, we have not paid the amount, it is going to be irrelevant. That's what accrual concept says about. Look at this theory. Transactions will be recorded in books of accounts irrespective of the fact that money is received or paid. Example, credit transactions are captured in accountancy like credit purchases, credit sale. All these credit transactions comes into books of accounts only because it's a accrual principle. If this principle is not there, what will happen? Only when the cash is paid, the firm will start recording the expenditure and income. So that won't work out. Once the transaction has accrued, you have to communicate that we have purchased the goods, but the amount is not yet paid. That point has to be communicated with the users. So we have this accrual concept. Like accrual concept, there is one more principle called as cash basis of accounting. That's also equivalently permissible. The cash basis of accounting, what it says is only when the transaction is settled in cash, either payment in cash or receipt in cash, only when the cash is involved, we will record the transaction. So this another method is cash basis of accounting. But if for companies, they have to strictly follow accrual. They can't follow cash basis of accounting. Next one, accounting entity or business entity concept. Now, what this principle is all about, it's straightforward one. Accounting entity or business entity, what it says is the company is separate, the promoter is separate, and we are recording the transaction from company's perspective. So, company is separate, owner is separate. These two are two different people. Suppose take myself. My name is Shivram, and I have this business called as SJK classes. Now, this academy, I'm the proprietor of it. I'm the owner of it. Now, from accounting perspective, this SJK classes is different. The myself, the proprietor is different. So, these two are two different people. That's what this principle says all about. Now, what is the financial impact or the accounting impact because of this principle? It is because of this principle only, whatever money I have infused into the business as capital will be called as liability from the business perspective, because SJK classes has taken money from promoter, myself. From Shivaram, the SJK classes has borrowed the money. The company has to repay it back to the proprietor. Hence, capital will be a liability for the business. Similarly, suppose company makes some profit. Now, why I have started this business? To make profit, right? So whatever profit the company makes, ultimately the profit belongs to proprietor. So profit is also a liability for a business, because profit has to be ultimately paid to proprietor. So the profit is a liability, capital is a liability. All these points comes into books of accounts because of this business entity concept. So capital and profits are liability for a business, because promoter and business are two different people, and company has to pay these two amounts to the proprietor. Similarly, if proprietor has withdrawn something from the business, we call it as drawings. Drawings is an asset for the business. So from business perspective, what happens is the promoter has taken money from the business now, the business will get back that money from the proprietor. So from business perspective, the money is receivable, hence drawings is an asset for the business. Most of you are making a mistake here. They are saying that drawings is an expenditure. Drawings is never an expenditure. Drawings is an asset for the business. So let's come back here. Owners and business are separate. We are preparing the accounts from business perspective. It is because of this principle, capital is classified as a liability, drawings as an asset, profit as is a liability for a business. So capital is a liability, drawings is an asset, profit is a liability, because all these are capital and the profits company has to pay to the promoter. Drawings, company has to get the money from the promoter. So drawings is a receivable, it's an asset. Profit and capital is a payable, it's a liability. Next one, accounting period principle. Now, what does this accounting period principle says here? Accounting period principle says that the company has to close down the company has to prepare the financials for yearly ones. So what this principle says is, I'll just show you the pro forma statement of P&L and balance sheet. If you prepare trading and P&L account, what it says, the heading is trading and P&L account for the year. You look at the words here, for the year ended. That means I am preparing the trading and P&L account for 1 year period. Why should I prepare for 1 year period? Why can't I prepare for 5 months once, or 2 years once, or 3 years once? Why can't I do that? Because of this principle. Which principle? Accounting period, also called as periodicity concept. Both are same thing only, both are synonyms. So periodicity or accounting period are one and the same. What this principle says is the company has to prepare the financials, or they have to break the lifetime of the company into smaller periods of 1 year each. If this principle is not there, what will happen? Some company will prepare the financials for 3 or 4 months once. Some will prepare for 5 years once. Some might prepare for 10 years once. Then how do I compare these financials? Because end of the day, accounting is nothing but it's a communication tool. It's a language of business. So if I have to compare between two companies, everybody should be speaking the same set of language. So for this uniformity purpose, we have been given with this accounting principle called periodicity concept or accounting period principle. What it says, the company has to break down its financials yearly once, meaning they have to prepare the financials every year. Usually, company follows April to March as a financial year, but they can also choose to go for Jan to December, any 12 months as they like. There is no restriction as to which 12 months it is, but 12 months once they have to prepare the financials. So, what is the expenditure income they have made for 12 months period? All that's what this periodicity concept talks about. Now, look at this theory part. What it says, financial statements are closed or broken into smaller periods so that performance of the entity can be found out. The smaller period means, what is a smaller period? We are referring it to yearly ones. And what is this performance all about? Nothing but computation of this profits and losses as well as to report the assets and liabilities. So that's what we are referring to, performance of the company. Then it is because of this concept, trading and P&L account is prepared on a yearly basis. That's what I showed you right now. Look at this heading, for the year. We are having this word for the year just because of this periodicity concept. Then materiality principle. Just now in the beginning, we spoke about this principle. What is this materiality principle is all about? Very simple. If a transaction is material, that is significant, it will be recorded as an asset in the balance sheet. Else, it will be recorded as an expenditure in the trading and P&L. So, if item is material, we have to disclose this item in the balance sheet. If not, take it to trading and P&L. This topic only. Discuss no. Machinery is generally an asset for a business, but depending on the company's size, we will classify the same machinery as an expenditure as well. So whether it's expenditure or whether it's etc., because both have debit balance only. Accounting entry will not change. Both will have debit balance, but the classification will change here based on the materiality principle. That's what this principle is all about. If a transaction is material, significant, it will be recorded as an asset in the balance sheet. Else, it will be recorded as an expenditure in trading and P&L. Purchase machinery for rupees 30,000. For a small size entity, it will be classified as an asset, and the same machine for companies like Reliance, TCS, etc., will be classified as a expenditure in P&L. Self-explanatory, easy one. The next one is Prudence concept, a very important accounting principle. It has got lot of relevance in higher level. Prudence concept is also called as conservatism principle. Now, you should remember one key phrase in this accounting principle. The phrase is, do not anticipate profit but provide for all possible losses. Now, what this principle says is, do not anticipate profit. What it means? It means that if you're anticipating some profit in future, don't book the profit now itself. Let the profit be realized, then you can book that profit in financial statements. However, if you're anticipating some losses in future, you can't wait for the losses to be incurred. That losses has to be captured now itself. So if it's a case of future profit, wait for the profit to be realized, then disclose it in the financial statements. If it's a case of losses, you can't wait for the losses to happen. The losses has to be anticipated and it has to be captured in books of accounts. Now, it is because of this prudence concept, we have a concept called provision for doubtful debts. What is this provision for doubtful debts? I'll explain you this. Suppose, let's say, I have sold goods to someone. Let's say I've sold the goods 5,000 rupees to a person called Mr. A. I have sold goods to A. Now, once the goods has been sold off, I have to receive the money, right? Let's say after selling the goods to A, subsequently I have given him, let's say, 3 months time. I have sold the goods to A, let's say on December 1st. I have given 3 months time for A to pay me back. So 3 months time is what? From 1st December, 3 months now it comes to February 1st. February, right? December, January, February. Okay, March 1st. So by March 1st, I have to receive the money back from Mr. A. Now, in this 3 months time, let's say, just for example purpose, on 22nd of December, 22nd of December, just 3 weeks after the date of sale, let's say Mr. A is facing some huge financial difficulty. So now what happens? I have a doubtfulness about the recoverability of the amount from A, right? I have sold goods to him. He has time till March 1st to pay me the money. Now, if suppose in the meantime, in this 3 months time period, suppose something happens to Mr. A, let's say his factory has been destroyed by fire, then what will be our thought process? We might feel that okay, this guy is in financial difficulty, he may not pay us the money. That will be a thought process, right? Now what happens if that is a scenario? We might have a doubtfulness about the recoverability of the money in future from Mr. A. Now this is what we call it as provision for doubtful debts. So anticipating some losses in future, I have to create some provision now. What is this provision? It's something like creating a piggy bank. When you earn some money, you take some money out of your earnings and you put it in piggy bank, right? Similarly, out of the profits, the company will take out some amount of the profit and they will put it in this piggy bank, which is called as provision for doubtful debts. So provision for doubtful debts are nothing but setting aside a portion of the amount from the profits of the company. Now, what is the accounting entry for creating this provision for doubtful debts? The entry is quite simple. See, I'm taking out profit from the business and keeping it as a rate. So what happens? The profits will come down. So what is profit to a company? Just now we discussed here. Profit is a liability for a business. Why profit is a liability? Because the profit will be earned in company's name. Company has to pay this profit to the proprietor. So let's say the company has earned a profit of, just for simple purpose, company has earned a profit of 50,000. Out of 50,000, I'm going to take out 5,000. Now what happens? From 50,000, if you take out 5,000, what happens? The profit will come down, no? The profit will come down to 45,000. So once provision is created, what happens? You reduce the profit. Profit being a liability, so we are giving it a debit. So the accounts involved are P&L account, where the profits will be captured, and the other account is provision for doubtful debts. What is the nature of profit? Profits are liability for a business. Provision is again a liability. Why provision is a liability? I'll look at this example. It will be much clearer. Let's say, I'll give you two examples now. First example is transferring of bank balance. Let's say you have a bank account in HDFC Bank. You have a bank account in HDFC Bank. You have opened one more account in SBI. In HDFC, you had a balance of 10 lakh rupees. Now, what you have done is you have taken out 4 lakhs from HDFC Bank and you have transferred to SBI. Now, what is the accounting entry for this transfer of funds? HDFC, what is the nature? It's my bank balance. Bank balance is an asset for a business. So HDFC is an asset. What is SBI? SBI is also an asset. Because in SBI, what is there? My bank balance is there. So HDFC and SBI both are assets for the business. Now, what is the accounting entry involved? HDFC bank balance reduces, SBI bank balance increases. So entry will be SBI account debit to HDFC account 4 lakhs, 4 lakhs. SBI asset increases, HDFC asset decreases. Now, let's move to example 2. What is this example 2 is all about? Let's say the same scenario, HDFC and SBA, but with one small change. Instead of bank balance, it is going to be bank loan. In HDFC, I have a loan of 10 lakhs. What I have done, let's say SBA is saying that if I take a loan with them, they will offer a reduced rate of interest compared to HDFC. So what I have done, out of 10 lakhs, I have transferred 4 lakhs worth of loan to SBA. So now what happens here? HDFC Bank, in HDFC Bank, I had a loan of 10 lakh rupees. Now I have transferred 4 lakhs to SBA. Now the loan amount reduces, right? HDFC loan has reduced. HDFC is a liability. And what is the nature of SBA? SBA is also a liability because in SBA, what is there? Loan is there. So the accounts involved are HDFC and SBA. Now what is the entry here? The entry will be liability reduces, you have to give a debit. So HDFC bank will be given a debit and SBA loan will be given a credit. So HDFC loan reduces, when liability reduces, I have to give a debit. When liability increases, I have to give a credit. So entry is HDFC loan to SBA loan. In both the cases, the amount is 4 lakhs, but entry is different. First case, entry was SBI to HDFC because it was a bank balance. In this case, the entry is HDFC to SBI because this is a case of a loan. Now, what is the takeaway here? The takeaway is, look at this SBI. The secondary account, SBA, from where did SBA get the money? SBI got the money from HDFC. So if HDFC is an asset, SBI will also be an asset. In the second example, if HDFC is a liability, SBI will also be a liability. So the takeaway is, in case of fund transfer, the secondary account will always take the nature of primary account. If primary account is an asset, secondary account will be an asset. If primary account is a liability, secondary account will be a liability. Now the same concept appears here. What is provision for doubtful debts? We are transferring money from profits P&L to provision, right? So if P&L is a liability, provision has to be a liability. That's what we'll be conveying here. So provision, why it's liability now? We have to say that we are liable to the proprietors of the business, because inside provision, what is there? Profits are there. You are taking out profit from P&L and you're keeping it aside. So if profit is a liability, provision will be a liability. That's a concept. Because once again, most of you are assuming that provision is an expenditure. Provision is not an expenditure. Provision is a liability for a business, and liability has a credit balance. Now what is accounting entry now? The P&L balance reduces because you're taking the money out of profits out of P&L, right? So profit will reduce, so you give a debit, and provision, which is liability, is increasing, so give a credit. Entry is P&L to provision. 5,000, that's accounting entry. So provision will be a liability for a business. Next one, matching principle. What is this matching principle is all about? Matching principle says that expenses should be matched with revenues of the company. Trading and P&L account is built on this matching principle. Uh, I'll show you this one. Look at this point first. Trading and P&L account is built on the matching principle. Debit side of trading shows the input into the factory, and credit side shows the output from the factory. I'll explain this concept clearly. It's a very important one. The trading P&L, no. The trading P&L, the debit side shows the input. I'll explain you what is this. First, what is opening stock? The it's something like the uh, opening inventory in a business. For example, let's think of a household. In our house, uh, mom cooks for us. Now let's say at the beginning of the month, we have 2 kgs of rice with us. In the house, we had 2 kgs of rice in the beginning of a month. For 1 month, for let's say family of 4 people, 2 kgs will be sufficient. Of course not, right? So generally, a house of 4 people generally consumes around 20 to 25 kgs of rice. Now what happens? I have an opening balance of 2 kgs of rice, which is not sufficient. So what I do? This 2 kg will be called as the opening stock. Now this 2 kg is not sufficient. So what I do? I have to purchase few more kgs of rice. So which is called as purchases. So the opening stock and purchases, these two things put together will give you what? Total raw material infused into the factory for production. So I repeat, opening stock is the raw material available at the beginning of the period for production. Since this raw material is not sufficient, I have to purchase few more raw material, which is called as purchases. So opening stock and purchases put together will give you the total raw material infused into the factory for production purpose. Now with this raw material, will I be able to complete the production? Of course not. With raw material, I need manpower as well. So that's what has been captured as wages. Whatever money I pay to the factory workers for production purpose will be called as wages. So with raw material and manpower, will I get the output? No. I will be incurring some other expenditure like power and fuel, etc. So those are the other things captured here. What is this carriage inward? Carriage inward are nothing but transportation cost from vendor place to our place. The transportation cost, whatever we incur, is called as carriage inwards. And what is power and fuel? Nothing but the power, whatever we consume inside the factory for production purpose. So debit side shows you what? The first two items will give you the total raw material infused into factory for production. Then wages will give you the amount paid to laborers for converting the raw material into finished goods. For converting raw material to finished goods, labor alone is not sufficient. I have to pay for power and fuel as well. So all these things put together, these are the costs incurred inside the factory for production purpose. Why do I spend all this amount? To get the output. That output will be either sold off or it will remain as closing stock in the business. So that's what we are saying here. Debit side shows the, look at this point, input into the factory, and credit side shows the output from the factory. So this much amount I have spent inside the factory. By spending this much amount, what is the purpose? I want to get the output. That output will be either sold off or it will remain as closing stock. That's what we're saying here. Coming back to this principle says that expenses, which is on the debit side of trading and P&L account, should be matched with the revenue. The expenses should be matched with revenue. Trading and P&L is built on this matching principle. Debit side of trading shows the input in the factory, and credit side shows the output from the factory. That output could be either sold off, which will be captured as sales, or it will remain as closing stock. It is because of matching principle, closing stock is shown on the credit side of the trading account. So if you see here, look at the third point. It is because of matching principle, closing stock is shown on the credit side of trading account. Conceptually, closing stock is an asset for a business. I'll explain you this point. Let's consider a scenario. Let's say we have purchased goods worth, I have purchased 100 units of raw material in the current period, let's say at rupees, some number, let's keep it as 50. So I have spent 50 rupees per unit to purchase 100 units of raw material. What is my purchase cost? The purchase cost is 5,000. Now let's say I have sold, let's say I have sold 70 units at a price of 80. I have sold 70 units at a price of rupees 80. 7 8 are 56, 5,600. This is my sales. Now, if you tally this account, what will happen? You get the total as 5,600. You will take it to debit side. The profit will come to 600 rupees. But actually, this profit is wrong. If you are saying the profit is 600, then you have made a mistake here. The mistake is in debit side, we are capturing the purchases for 100 units. The expenditure is for 100 units. You're comparing 100 units expenditure with 70 units of revenue. These two are not comparable. To put it even more clearer, I'll give you a basic mathematical concept now. See, I have purchased the units at 50 rupees, right? I have sold it for 80 rupees. Now, what is the profit we have made for one unit? For one unit, the profit is 30 rupees. So if one unit, the profit is 30 rupees, how much profit I should have earned in the current period? For one unit 30 naga, for 70 units, the profit should be 70 into 30. It should be 2100. But if you tally this account, you are getting the amount as 600 only. What is the reason? Because we have not captured the closing stock. Here, the closing stock is what? 30 units at a price of how much? 50. So 30 units is pending, right? Because you have purchased 100 units, you have sold 70 units, 30 units is pending in the business. So for 30 units, what will be the value? 30 into 50, the amount is 1500. Now what happens? Now tally this account, you'll get the answer. Credit side, the amount is heavier, it comes to 7100. Take it to debit side. Now the profit is 2100. Mathematically, what should be my profit? 2100. It is 70 units into 30 rupees. So this point, what we're coming here now, because of matching principle only, we are disclosing the closing stock as an income in the trading account, right? But conceptual, what is closing stock? Unsold inventory of current period is closing stock. This unsold inventory will be sold in subsequent period, no? So you have got some future benefit. So closing stock, technically, it's an asset for a business. If you see the financial statements on the asset side, if you see here, you'll have this inventories or stock. You can look at this point here. So inventory is an asset for a business. Then why do we show it in trading account? It's because of matching principle. Without capturing closing stock, my profits will be wrong here. So to get the correct profits, I have to disclose the closing stock in trading account. So I will move on now. Look at this points once again. Matching principle. This principle says that expenses should be matched with revenue. Trading and P&L account is built on matching principle. Debit side of trading shows the input into the factory. Credit side shows the output from the factory. It is because of matching principle, closing stock is shown on the credit side of trading, but conceptually, this is a asset for a business. Next one, the last important accounting principle is substance over form. Now, what this principle says is, it's a very easy one. Look at the wordings itself. Substance over form. What it means is, from accounting perspective, substance of the transaction will take priority over the legal form. I repeat, from accounting perspective, legal form will be irrelevant. Substance of the transaction will take priority over the legal form. I'll give an example for this. Example, sold a building to Z on 13/3/25 and legal formalities for sale were completed on 10/4/25. So I have sold the building on 13th of March, whereas the legal formalities like transfer of title deeds, documentation is there, no? All those things gets completed on 10/4/25. Suggest in which year the sale of building will be recorded. So the building was sold on 13/3/25. Now what is accounting year? The accounting year is 24/25. Whereas documentation, the legal part has been completed on 10/4/25. Now, which financial year it is? It is coming in the financial year 25/26. Now, is the sale should be booked in, sale of building should be booked in 24/25 or 25/26. This question arises, no? For this clarity only, we have this accounting principle. What it says that substance will take priority over legal form. So, substance is what? Sale of the building, no? In which period building has been sold? 24/25. So in 24/25, building has to be shown as sold and not in 25/26. So legal formalities is irrelevant from accounting perspective. So based on substance over form principle, sale of building will be recorded in the financial year 24/25. So in this session, I have covered the application part of the accounting principles, some important principles alone. There are a few more principles which are some trivial topics. So just focus on the main concepts alone here. And just one point I'll add here: don't use any of these points for your examination. For examination, just go by the book. Just for understanding the concept of this accounting principle, use this lecture. From examination perspective, just go with the book wordings. But the application part, this is how the principles will be applied in real life. So that's it. Any doubts you can ask me. Thank you.